the whole time we're both live.
Watch what you do over there.
I need to know that.
Yeah.
You know?
Yeah. They're going to be able to see that face the whole time, man.
I'll be like,
yeah.
What's he saying?
Every time I talk, he's like, no. No, it's not like that.
That's good to know.
Welcome to our Friday Fin Tips, everybody. How we doing today?
I'm on, so I was waiting.
Yeah.
It's the double live here.
Oh, man. Hey, we're going to talk about something interesting today. We're going to follow up on a show that I was doing at home. I call it Jazz After Dark. I actually had shared some data talking about how you might want to consider the spread between your current income and your retirement income. But I did it differently, where I didn't try to guess you guys' income. I did it by tax bracket. So we actually broke it down. And I'll share on the screen here real quick something in a second. But Eric actually found a point where that is no longer effective. So I give you the basics that fits the general audience. Eric's going to show the extreme today where, okay, you can't always consider things like this. Right, Eric?
That's exactly right. But, I want to point out that today I'm rocking Dad, not all superheroes wear capes. So my daughter brought this in this morning. And they've got like a holiday shop thing. And she's like, hey, we went to the holiday shop. She was so excited about
at school, right?
Gifts, yeah. And we're like, you don't want to wait till Christmas? She's like, nope, I want to do it this morning. And so, little special edition today. Got my.
What's it say on the bottom?
Cup. Not all superheroes wear capes.
Oh, I got it. Yeah.
So I don't know if that's referring to Dad is the superhero or if it's just a whole different message on the same cup.
You remember the day that you figured out your dad wasn't a superhero?
Oof.
Every kid has it at some point.
Love you, Dad.
Yeah. No, man, he's still the hero, man. Oh, anyways.
He's a great man.
Let's go through it, and I'll kind of explain it. If you didn't see the Jazz After Dark show, maybe check it out. It's something new that we're trying there. But here's what we're looking at. So on the screen, we've got just a simple spreadsheet that I put together to try to illustrate the point of if your tax rate now is 22% or higher and your tax rate of retirement is 15% and you have all your contributions and everything, we can actually look through and find that in this case, you lose 8% of returns. You're not like losing money from investments. I'm saying the difference is 8% less by using a Roth. So we wouldn't want to use the Roth in this case. And the point I was trying to make was the spread between one's income now and in retirement. Oftentimes, and I hope this for you guys, you make 100, 200,000, 300,000, whatever it is, and you're saying, well, I want to put money in a Roth. The tax you're paying now is so much higher than the tax you'll pay in the future, and that's what I was trying to show, with just a tight spread. Yeah. And so that's, to me, is really important because everybody gets that wrong, and look at what you're missing out. You're missing out on 8% in terms of total returns there. Come on now. Every little bit adds up.
Yeah. It's good math. I like the math on it, and I like the idea.
Well, it's not math, it's a spreadsheet.
Well, but the breakdown of it. But the idea that with something like that, what people don't look at, you really adjusted for the sake of, hey, you're going to put a little less in the Roth. So I've always tried to tell people this. If you're wanting to do pre-tax money, the reason you're doing pre-tax is to save more money on taxes so that you can save more money in general.
Yep. So total tax, man. You got to think in terms of total tax instead of like, oh, I need to lower my tax bill this year. Mm-hmm. Accountants are great at that. They want you to save the most on taxes this year. Yeah. Planners and advisors go, well, this year's great, and I hope that works, but we want to do every year. We want you to save as much total tax as possible.
Yep. Yeah. And I mean, I understand. I understand the accountant side of it. Hey, let's save them today because
that's what I would do.
Yeah. Well, that's what everybody wants to do.
I mean,
I don't want to. I want to focus on the today of that, but that's where I was looking at it, and basically the breakdown that Dustin shared is a perfect example of how the pre-tax works better. But then I said, hey, well, what about the challenge? Because I actually had a client that I'm right now working with on some of this, and they've done so well at saving. So much of their money is in pre-tax, plus they have quite a bit in a taxable account to lower their income during retirement years at certain times so that they can do even more in conversions. Yep. So you fast forward, you do a lot of pre-tax now, you do the Roth conversions, but what point does that come into play as far as things go? Because what ends up happening, kind of like bouncing here, what ends up happening with this one is that the RMD is going to crush these people. Yep. Because they've always lived a frugal lifestyle. They continue to want to live a frugal lifestyle in retirement because it's kind of hard to change. I've had to tell them, you're either going to have to spend quite a bit more, you're going to have to retire early, or you're just going to be paying massive taxes and leaving a ton of money to kids.
Isn't that funny how we meet people? Like, if this were not my job, I would never think like this. But you meet people and they're like, I'm just happy, dude. I'm just doing my thing. And you're like, you have so much money. You realize you have to do something with it.
Yeah.
And they're like, I don't know, maybe something will come up. Whereas like in my head initially, I was like, brother, give it to me. I'll show you how to spend it, But now as I get older, I'm like, I don't know. I got nothing. What do you want?
Yeah.
But this is going to be a case where, so if you don't convert, and by the way, conversions are an easy thing for an advisor to say. They're a really hard thing to do as in active practice because, you got to pay a big tax bill and you're trusting that number is right. And, it's hard. Yeah. So what I was sharing works for the majority of people. But if you're really good at money, like Eric's going to show you, you reach a point where you go, no, you convert the devil out of this. It doesn't make sense for you to follow that actual approach.
Yep. Not only that, but the factors that oftentimes we can't, I think it's one of the hardest things as an advisor to truly predict the tax strategy and what's best. Yeah. Because yes, we can tell you what today is, and the CPA can as well. But fast forward 20, 30 years, a great example I just shared again the other day with somebody was I have an 84-year-old client, and she's in a position where she's having to take a lot of RMDs past what she's already living on. Mm-hmm. And she's upset about having to pay the taxes, but unfortunately, that's just how this goes with all the pre-tax accounts. You got to start taking money. The older you get, the more you have to take. And it's all based on the calculations there. But what ended up happening with her was she lost her husband. Well, now fast forward to she's 84 years old and it's all pre-tax money and she's a single filer now, or, filing as a widow, but you don't get the break after a few years that it's basically, hey, you're in a single tax bracket. And when you're in the single tax bracket and you're older and you have to take these RMDs, we can't model out that. Like, I don't want to tell everybody we're planning, be like, all right, well, what if you die tomorrow? Your taxes are even worse. So, we can really talk about it, but at the same time, that's a whole nother aspect of this that I didn't even calculate into this plan itself. This is just based on both of these people living, till, around 90 years old.
Yep. And what I like about the tax laws as they change regarding our software is, as we're working on it, we don't just make a plan and send you on your way. Like, the plan stays. Yeah. And for example, next year, early in the year, the tax laws are going to change a little bit regarding retirement accounts. So it's like, okay, we can go look and say, well, what do we do now? Is the plan still steady as she goes, or do we make a change? Because it's going to change. It's these stinking tax things, man. They get you one way or another.
Yep. All right. So I'll jump in here. I'm going to show what we were talking about, because the idea is, yes, the general calculation that you had put together is awesome, but this is a whole nother side of it. So this is a picture of Nest Egg, our planning software, where we're looking at doing Roth conversions. If this person does Roth conversions, everything else the same, this is an insane number, honestly. But that's where, again, I'm looking at the fact that these people have saved so much and they're wanting to live a low income lifestyle. They're going to have to do conversions, or that money's going to be forced out with RMDs.
But does that ever change, by the way? Like, okay, so the person wants to be frugal and they have no intention of spending more money. And here you are going, oh my God, you need to do these conversions and what you're going to show. And it's like, does the person ever say, no, I don't want to. I don't need to. Like, why pay the tax now? I'm never going to spend the money. What if they just say, fine, forget it. If we have to spend more as we get older, we'll just put it in the bank.
Yep.
That's an acceptable answer, but keep in mind, old Eric over here is like, wait a minute, I want to show you how you can end up with more dollars. I wonder how you get that to ring with somebody where they're like, we didn't need more dollars.
So the one idea with this one, and I'll show you really how I calculated the math on it, but the idea is that I actually have it on my phone because I didn't get the time to build out my pretty little nice graphic for you there. But it's all looking at the total tax paid.
Yeah.
So if we can look at the total tax paid, that's what's going to be the ultimate factor. Because if I could tell these people in this scenario specifically, if they convert this money up front, they're going to have over $8 million more tax adjusted at the end of the plan. That's massive. And I know it sounds crazy, but this is a legit real life plan here. This person, if they do this, total tax from 2023 till the end of the plan
That's crazy.
is going to be $1,775,000. But if they don't do it because of RMDs and the way it's all going to work and the fact that the government's going to push all this money out, and this was mind-blowing. I actually had to run the numbers multiple times to make sure I didn't mess this up.
Yeah.
They're going to pay over $8 million in taxes. And that's where, it makes sense. Hey, a proposed strategy is going to give you $8,340,000 more of tax-adjusted money at the end of the plan. Well, it makes sense because now you're paying $8 million in taxes. $878 million. There we go. There's the
Just
number.
you can't even say the number.
It's too big. $8,772,277
So
in tax.
blows me
just makes
away
me
right
sick.
there. Right. So just think of them. If they do it, think of the money they just saved. Right. That not every one of our clients can't pay that amount of money to us. Like that saved them so much more than they'll ever pay.
Yeah.
But if you look at that and you go, all right, I'm done. I don't have $1 million, $8 million. I don't live like them. I want to spend money. Okay, take 1/10 of that. Take 1/100th of that, right? To see the difference.
Yeah.
At some point, 3 zeros mean something to you and 5 zeros mean something to somebody else, right? We all have different sums of money. That's okay. But take a percentage of that and go, okay, something happened there. I don't know what they're talking about, but something happened which meant that they paid less tax over their total lifetime, which meant more money in their pocket. And so put yourself in that shoe, right? You're going to get to that point. Even if you're behind and you haven't saved enough, you're eventually going to find yourself with RMDs, looking at conversions and stuff. There's a huge savings there. But again, easy for me to go, come on, man, take a look at this. This might be something you should do and push you. I promise you, it is much harder for someone to go, how much is the tax bill this year?
That's it.
Okay. Yeah, if you say so, I guess I got to do it.
That's the hardest thing. I mean, to come up with the idea that, hey, I'm going to have, and a lot of people, I can look at the best conversion strategy, but it's like, well, I don't have the cash to pay that.
Yep.
Or another scenario with this is, hey, well, I'm still working. Yes, your model shows convert now, and that's the best scenario, but I can't convert now because all of my money's in a 401k. I don't have a Roth 401k where I can convert at the job.
Yep. I'm
not of age to actually do an in-service rollover or do anything else. So there's a lot of limitations there, and that's why this really is one that I feel is the hardest thing that we can figure out. We can do the best we can with what we have, and also we have to, I'm not there trying to beat somebody over the head to say, hey, you have to do the conversion because get ready, you're going to pay on this one alone. Their tax bill this year, next year is going to be $63,000 based on what they're currently doing. Ooh. If they do the conversion, their tax bill is projected to be
6 figures.
Loading.
Oh, it's going to be 6 figures.
All right, what's your guess?
113,000.
That's a pretty good guess. I know I saw it, but I was waiting on it to load so I can have this.
Well, that's why I'll interrupt for a second because when you talk about the way I usually pitch it to clients is no conversion, and something in the middle, right? So there's do nothing and pay tax. Maybe it's more for some, less than others. Or you can go full on, the most efficient way for you to pay the least tax over your life. 9 times out of 10, the person says, let's come up with something else. I'm not going to convert this year, next year, or the year after, but I'll have some money and then I'm going to do it in 3 years. So we'll start it then, we'll stop it for a few years and stuff. I love that new setting in Nest Egg there.
Yeah. No, that's
113, did I get it?
Here's the thing. As much as we like to do these shows and everything's working on the fly with this, unfortunately, sometimes technology plays against us. It's spinning. So I was
refresh. I got to know now.
Hey, so we're gonna have a little post edit. So I've got some stuff for Cody there, but we're gonna show it, and I'm gonna show. Actually, I know what it's taking longer than usual. And so
well, then I get to do this.
There it is.
I was gonna say, edit me in there, going, yeah, I got it right.
Man, I was sweating it. I'm literally like worried about this now. It's 116,282.
Oh, okay.
But you're right there.
That was close.
You took the under. If I was over under, I mean, you won the
Price is Right.
Won the deal. But here's what I really want to show, though, is because if we fast forward in this cash flow breakdown here, so what I've got to look at is plan distributions. Plan distributions is going to be really required, RMDs. Well, for this, it's showing they have a Roth 401k. So what people don't realize is you actually still have to take money out of a Roth 401k. That's why it makes sense to roll that over instead of you having to take it out of there. So if you roll it over, it's in a regular Roth IRA, you can leave it. You don't have to ever take the money out. But if it's in the Roth 401k, it's a bit different there. So with this one, that's all they have to take out. But if I go to their current plan and I look at the planned distributions that they're going to have to take, now let's see if this one loads. There it is. There it is. So we fast forward up here to, age 72. They've got to start taking a little bit of money out. But this is where I start to really stress that, by the time both of them are at RMD age, they're having to take out their planned distributions are $368,000. Fast forward, they're going to have to take out, at some point $1 million when their expenses aren't near that. They're getting forced money out consistently that you're paying this massive tax bill on. And I know that's hard to wrap your head around.
That's such a crazy number. But
it's like, they've just done well saving. It's crazy to think, but in the end, it truly is a unique scenario where each person and the discussion of, what are your goals? Are you okay with paying more in taxes later on? Because I have yet to meet one person that's in their 80s that doesn't complain about RMDs.
Oh, yeah. I have clients that are actually just trying to give them away. You can do that, but they're done with it. They're like, I had to take out so much last year. No, I'm going back to 2018 now when we were talking about that. And because 2021, they got rid of that for COVID. But I think it was like 2018 or 19 where it was people just saying, well, who should I give it to? And I always joke about the SPCA because people did that. They're like, I'll just give money to the SPCA. I don't know. Yeah,
there's the QCD strategy where they can give the money first to the charity. The one I talked about, the 84-year-old that I knew that was having to take too much out, they were like, well, can I give this to my kids or somebody? The problem is they still have to pay the tax.
Could the 84-year-old not marry her friend just to get the filing jointly?
Hi, friend.
Totally off topic.
Are you calling me friend?
Or I'm just saying.
I can help her out.
Me and you. Let's
spend
just
this
say,
money. No.
Let's say let's say you're 83, I'm 87. We both outlive our wives. We're sitting here with money RMDs and a single tax bracket. What do you say, man? What do you say?
It's an option.
You know what I mean?
It's an option.
Get you a little place in the corner of the house,
Yeah.
And we just file our taxes joint,
Yeah.
IRS comes over.
Stay over there. I'll stay over here.
Yeah. Well, I'm saying if the IRS comes over, we may have to hold hands or something. But
well, the saddest thing is honestly, is how they kind of push that because, so my grandfather went into a nursing home. He had Alzheimer's. It got kind of rough, and she was in a position where she had to pay all that out of pocket. They had done well enough saving where basically it was like, hey, you have to pay for it. Medicaid's not going to step in. And they just told my grandmother, she's very, morally, she's got her thing there and she's not doing this, but they were like, just divorce him. If you divorce him, you can take all the money because you have power of attorney and he can't make any decisions. You'll have all of that money and then he'll get on Medicaid. And she's like, I'm not doing that. And I respect her for that, but it just goes to show how sometimes the system, you want to be an honest, ethical person, but the system sadly can
we had
play against you.
That call it ethical or not, but there was a client who was very terminally ill, found out pretty last second, and between their attorney, their CPA, lifelong family friend, and me, we all agreed that they should get divorced because it was just there was so many different things that were happening there, but it was like they were looking at me for the answer, and I'm like, would I do it? Probably.
You would?
Because we were talking 100 for them.
The numbers.
They each made $40,000 a year, or somewhere. Maybe one made 40 and the other didn't. But we were talking about $120,000 difference in everything they could add up, and I'm like, would I do it? Yeah.
It's so tough. It's so tough the way the system plays. But wow, that's some Debbie Downer stuff to finish this thing out.
Well, let's wrap it up with this then. This is the clip of the day. You ready?
Okay. What's your clip of the day?
So hypothetically, let's just throw this out there. You know how they do that? Like if you're not married in 3 years, and I'm not married. Okay, hypothetically, you're 83, I'm 87, and we outlive our wives, right? Okay. You got your nest egg, I got mine. We're taking RMDs, and me and you get together, and we're like, hey, man, I'm in the single tax bracket. This is killing me over here. Hypothetically, You there for me?
No.
We go tie the knot?
No.
Do a little Vegas trip? My treat, brother. I'll do it.
No, on that, I'm wrapping this thing up.
Come on, man.
And how about this? And that's the plan, man. So that's a new one saying, but it didn't really
that's a
go
little
with
better.
that though, with what you just said.
So we're not.
I'm throwing that out.
I got to find somebody else to marry. I mean, by then you could probably marry a couch, for all God's sakes.
Yeah.
I don't know.
Yeah.
All right. Well, this is going off track. I will wrap it up there. Eric is obviously wrapped up, and thank you for putting up with us today. And hit the
Yes.
subscribe button. We're trying to look a little bigger out there. It helps us out, and I'll hope you guys have a great weekend. Adios.